I am Jeff Webb. I am Vice President of Professional Services here at Anderson Advisors. With me today is Eliot Thomas, the Tax Advisor Manager. He's in charge of all your tax advisors at Anderson. Toby Mathis is unable to be with us today, so we're going to try to pull through without him.
So just a few of our rules for those of you who are new to us. This is a Ask Live via question and answer feature in the Zoom. So if you have any questions, please don't put them into the chat. Please put them into the question and answer section. We have a whole staff there, and I apologize, I don't remember everybody on it, but we do have a team there of our CPAs, EAs, just about everybody back there answering your questions, and they'll try and get them through there. So again, put them on the chat the question and answer section so they can get to them. We'll get through all the questions that we can. We do get a lot of questions during this 1 hour or so. And then the chat would just be for other questions. And we may not be able to get through all those because we have our list that we have already picked out that we have to get through as well.
You can also use chat if you just want to be rude to Elliot, that's fine.
Yep. And then any other questions that we don't get to, feel free to email it into Tax Tuesday at andersonadvisors.com. If you need a detailed response, you can become a platinum member where you can submit these questions online. If you already are a platinum member, then you know you can do so. Then lastly, we just try and get through this a few questions and have an educational section where we just while we're explaining the answers, just to give you guys an idea of just more than just what the simple yes no answer is. We try and go a little bit more in depth, maybe come up with some scenarios of where we would do something this way or that way. Kind of just playing off your questions that we've already selected.
I know we have Pio and Troy and Dana. I don't think we're, I'm sure I'm missing somebody.
Dutch is in there, I know.
We are less than a week out from our big April 18th deadline, so we may be a little short of people today to answer the questions.
We got Ian and Christos as well. Outstanding.
Nice.
Heavy hitters. Everyone.
There's Ian and Christos are my two senior tax managers. They carry a lot of my load in the tax department. So yeah, I'm glad to have them on.
Absolutely. So let's see what we got here we'll just read through the questions here. We're going to go through all the questions that we will be reviewing, then we'll come back and start answering them. First of all, first question, I am thinking about investing in a Bitcoin mining fund. We will take 90% depreciation in the first year. Can I use that loss to offset against my gains over the next few years of the fund? Passive loss for passive gain. And number two, our business generated substantial income in 2022 in a single member LLC. Can I create a new LLC and elect S Corp status in 2022 and move income from the single member LLC, the older one, into the newly created S Corporation and be taxed as an S Corp for 2022? Third question, is it true that creating a revocable living trust will raise my capital gains taxes if I sell my primary residence home versus if I transfer transfer the house into my name, I must live in it for 2 to 5 years to qualify for lower capital gains taxes. Number four, I have sold a real estate transaction in 2022. Can I avoid capital gains taxes if I purchase another real estate transaction in 2022? Number five, if I am a retired person wanting to give a sum of money to my son, how can I advise him regarding deferring taxes on that inheritance money? Number six, kind of a long one here. I'm on Social Security and still an entrepreneur, but currently have no significant income outside of the Social Security. And I'm looking to buy a duplex with my business partner's mother, whose sole source of income is also Social Security. And where we would each reside separately in the 2 units on each half, I guess. I understand that as co-borrowers, we would be fully responsible for the payment of the property if the other one dies, and the other person is fairly concerned about her liabilities if something were to happen to me. The question is, a living trust a possible vehicle to address her concerns, either by guaranteeing the payment account or by paying off some of the selling of the property, or some other means such as a life insurance policy tied to the property. Also, in the case of the need for either of us to get medical care or care facilities of some nature that will look at the assets, is there a way by means of using the living trust or some other financial vehicle that can be used to protect the assets for the other party?
Long question.
Yeah. Then I think we're on number 7 here. I have a $14,000 tax liability for 2021. I need to open a SEP or a simple IRA to reduce that 21 tax liability. What else can I do for 2021 to lower the taxes. Number 8, my LLC bought a fixer-upper in 2021 and sent the 1099 to the contractor who did the repairs. Property is now rented. Does my LLC have to include that 1099 for repairs in my 2021 taxes, or do we have to wait until the property is sold? All right. And then if I rent a property, is it better to declare it as personal income, or should I better register an LLC or S corporation? Thanks. And can you explain what cost segregation is and how you apply it when you buy a rental? What can be used in cost segregation? Also, if you depreciate a rental property for 5 out of the 27.5 years and then sell, how does the recapture work and how do you calculate it? I think
There we go.
there it is. Sorry about that. So I guess this is just how you can reach out to us. YouTube,
Yeah.
Google Podcasts.
Yeah, that's some of the things where we have a lot of our content. YouTube, we are on YouTube right now, I believe. You can ask your questions through YouTube and they will be relayed. Replays, you can watch replays. I think some of them are on YouTube, but you can always get them if you're a platinum member. They will be available in your platinum portal.
All right. So let's get started then. First question. I am thinking about investing in a Bitcoin mining fund. We will take 90% depreciation the first year. Can I use that loss to offset my gains over the next few years of the funds? Passive loss for passive gain.
If you're investing in a Bitcoin fund, it's probably going to be passive to you. Bitcoin mining, meaning you don't own the equipment, you're not actually doing any of the mining yourself. So yeah, you're going to get 90% depreciation on all that equipment they purchase, probably thousands of dollars. But if it's all passive, you're not going to be able to recognize it unless you have other passive income. And since this is business income, we talk about the active real estate rule, where you can deduct up to $25,000 if you're in a certain income bracket. There's nothing like that for business passive losses.
That's right. Just for real estate. I would just say that, for those of you who've heard a lot of our questions about Bitcoin taxation, things of that nature, the fact that this is a mining operation, typically you hear that mining is an ordinary activity. Probably not what we have going on here, because as Jeff pointed out, this isn't a fund. So probably it's set up so that the investor is maybe a limited partner or something like that too, where it's going to be all passive to them. Just keep in mind though, for those of you out there who are mining Bitcoin, that is typically an active business and ordinary income, and we would set that up in a separate C corporation or something like that typically for you.
Yeah, it's investing in a fund is quite a bit different than doing the business yourself. You actually probably have a staff of people in this fund that's actually doing all that investing.
Yeah, which gets back to the for all those real estate clients out there where we talk about the material participation for real estate professional status, same thing in a business. If they're not materially participating in the operation of that money fund, then it's just passive to them typically, which is, I suspect, what we have going on here. All right, that's number one. Number two, excuse me, our business generated substantial income in 2022 in a single member LLC. Can I create a new LLC and elect S Corp status in 2022 and move income from the single member LLC into the newly created S Corp and be taxed as an S Corp for 2022?
Yeah, you and I talked about that this morning. Yeah, sometimes we talk about these questions. But you and I were both in agreement that this is taking the long way around.
Yeah. If you have an LLC already as a single member, and I'm assuming that by single member you mean disregarded, maybe we shouldn't make that assumption, but we're going to go ahead. You can go ahead and do S election for it in 2022. You don't have to move it anywhere. You can do what's called late election. We do it quite often. You just have to have certain, there's a checklist of things you have to do, mainly having the right language at the top of your return and things like that. So you could go ahead and get this in an S corporation for 2022 and not bother with a new entity. I can understand maybe there's reasons you might want a new entity later on. Well, at the end of the year, you can set up the new LLC and then merge that business underneath it, and or start it all over in the new one for next year if you wanted to.
Yeah, while we're past the deadline for creating an S Corp for the whole year, like you said, we have that late election terminology that will let us do it anyway. And I very seldom see them turn that down.
Yeah, I've never seen it myself. They have the right to, but they are usually quite generous with granting it.
So we can make your existing LLC an S corporation for the entire 2022. If you created another LLC, it would only begin at the earliest sometime in April.
At the date wherever you started it,
Yeah.
going forward, you'd still have that tag at the beginning of the year where you weren't an S Corp. You'd be talking Schedule C there, which we frown upon, higher audit risks traditionally. So really your option here would turn that LLC into an S corporation, get through it. And if you're not really happy with it, maybe you wanted it in a different state or a different operating agreement or something like that, we can always set up the new one beginning of next year and actually put that business, started under the new one, or look at different options.
So before you go to LegalZoom, create your new S corporation, talk to a business advisor here and they'll give you some good advice.
Yep. All right. Number 3, is it true that creating a revocable living trust will raise my capital gains taxes if I sell my primary residence home versus if I transfer to my name, I must live in it for 2 to 5 years to qualify for the lower capital gains tax? So yeah, we talked about this one as well. First of all, I'm going to jump back to the last part of the question here first, where I think the client is asking, well, if I do it in my own name, I have to do it the old fashioned way too. I have to live in it 2 of the last 5 years. You're going to have to do that no matter what. If you want to take advantage of 121, that's our exclusion. So we're not getting around that. It's just a matter of what you're distinguishing whether or not it's put under the living trust, the revocable living trust, or basically in your own name. That can be done, but you got to be careful because in the wrong kind of trust with the wrong kind of language, it could foul it up. But putting it in a revocable living trust itself, typically that's a grantor trust, and it can be taken back out, and that usually doesn't impact it negatively.
Now, what Section 121 says, it doesn't change your capital gains rate. It just says this amount, either 250,000 or 500,000, depending on if you're married or not, is excluded from gain recognition.
Yeah.
And as you said, you had to live there in 2 of the last 5 years before you sold the property. Putting it in a revocable trust, the living trust, is usually not a problem. The one caveat I will say is if you are married and you both are co-owners, you may want to talk to somebody first. The reason is because should you pass away before your spouse does, that trust becomes an irrevocable trust. And at that point, it could cause issues with the 2 to 5 years, even though your spouse is going to get a step up in basis. But it's a good question to ask of what happens if I die before my spouse or my spouse dies before me. Does it foul up the exclusion?
Yeah, and there's definitely situations out there where people have kind of different trusts that develop once one's passed that could maybe take away the ownership of that property from the other spouse, where they just have what's called life estate, and you may not be entitled to it then. So there's some issues there, certainly. It's a great question. Glad you asked it, but we'd want to sit down, and it can be structured in a way that would be all right, but you want to sit down and make sure it's structured that way.
There's another kind of trust called the Qbert, not the old video game. The Qualified Principal Residence Trust, I believe it is, that also kind of serves the same purpose. I don't know that we promote those.
Yeah, we haven't done a lot with those that I've seen.
But they are out there, and that's something else you could look into to kind of retain
the 121.
The 121, thank you.
Yeah. All right.
Did I tell you all that we're a week out from the deadline? Oh, go ahead.
Next deadline. All right. Next question. If I have sold real estate, I have sold a real estate transaction in 2022. Can I avoid capital gains taxes if I purchase another real estate transaction in 2022? This is a popular question. I hear this all the time. So Jeff, I sell something, I got capital gains in this year. Can I take it automatically and go and invest it in something else and not have to pay capital gains on it?
It depends.
Yeah.
If you have already sold it and you've gotten the proceeds from the sale, Section 1031 is off the table, the like-kind exchange. And that's pretty much what you're talking about, that I want to sell my property and replace it with another property. Well, when you do that, you have to use what's called a qualified intermediary, and you can never touch the money.
And it has to be done within that tight time frame, 45 days of listing the new properties, the replacement properties they're called, and a total of 180 till from the sell of the original to, and you can't just pick out and start at 1031 right after the process. It's really too late. And as Jeff points out, you want to work with a qualified intermediary. I think you're required to now. I believe after the 18, I don't think you have a choice. I think you have to have a QI.
Because if you get a hold of the cash in any form, you're done.
Yeah. So we're not going to avoid capital gains tax in that manner by reinvesting, perhaps like that. There is still the opportunity zones where you could put capital gains in there and defer for just a little bit. I don't think that's the maybe the best choice, because it is just a temporary deferral for a very short period of time. And then
and the 10% step up's gone.
Yes. Yeah. There's no step up. All the real juicy parts of the opportunity zone are gone for the most part. So that might not be an option. Still outside of this, really thinking outside the box for this particular tax question, there could be other things that you're doing. If you invested in the right kind of real estate, short term, and you materially participate, or you or your spouse have long-term rentals, you might be able to do the old bonus or some cost segregation and bonus depreciation, which we were going to get into in one of the later questions. But those might be other methods to hit your return somewhere else, lowering the effective tax rates all over the return, maybe impacting your capital gains, maybe not, but at least we'll go through your ordinary income first, which is always best.
Mm-hmm. And depending on how much gain you have, what's the number that Toby usually quotes? If you're married and making $85,000 or less, you're not going to pay any capital gains tax.
Yeah.
I think the next bracket comes in, you don't hit 20% until like 400 or 500.
Almost 500 now.
Yeah.
Yeah. So yeah, it's 0 up to like approximately 85, married filing joint. But remember, that's collective income. People get honest or understandably confused on this. That's all the income, including the sale that you just had. So if you had 40,000 W-2 income, 35,000 of a capital gains, the capital gains would be at 0. But if that total goes over 85, then you start paying capital gains. All right. I'm a retired person, want to give a sum of money to my son. How can I advise him on regarding deferring taxes on that inheritance money? The first thing is you don't need to tell him anything, because he's not the one who has to pay taxes on it. I can give all kinds of money to Jeff. He doesn't have to pay tax. The recipient doesn't have to pay tax. It's the grantor that may have to, the donor, the person gifting, if it goes over a certain amount. Now it's 16,000 a year right now that I can give without having to report anything. It doesn't impact me at all. But if I go over the lifetime exclusion, which is just short, maybe around 12 million, it's 11 million, 11.7.
12 million and 60,000.
There we go. We broke 12 million. That's a lot you can give away in your whole lifetime. So I give Jeff $1 million today. Now I do have to fill out a form if I went over that 16,000. I think it's a 709. Always mix it up.
709 for the gift.
The 706 and the 709 very similar to me. But anyway, the 709, we file that form. And it just tells the government, it doesn't create any tax burden, just says, hey, I gifted to Jeff $1 million. I want that taken away from my lifetime exclusion. Don't have to pay any tax. And certainly Jeff as a recipient doesn't have to pay any tax. So what I would tell your son here isn't what he needs to do about deferring taxes unless it's over $12 million, but maybe about how to invest it so that he can have great tax returns, like get into real estate or something like that, or proper structuring with trading in Bitcoin and things like that.
And what that gift tax return does, that you gave me $1 million and you filed it, you're saying I gave away $1 million, and it's going to lower that $12,060,000 limit down to $11,060,000.
Yep.
So it comes off your estate. So when you die, they're going to look at how much, I believe it's called credit, is left for your lifetime estate. No, that's the wrong word. But for your estate.
Yep. I'm a bit short on that right now. I got a ways to go.
I also want to talk about you mentioned the $16,000 gift, the annual exclusion, where you don't have to report anything. Well, let's look at the math and the multipliers in there. So I can give my son $16,000, but I'm married, so my wife can also give my son $16,000.
That's right.
And my son
32,000.
is married, so we can each give her $16,000. So we can effectively, by giving to different individuals, giving to different people, we can give $64,000 to
Couple to couple.
couple.
Mhm. Yeah,
So
it's a really great deal, and none of it has to be reported.
something we never talk about is also the 529 gift. You can donate up to 5 years of 529 deduction, 5 years worth of gifts. So that'd be 80,000 now.
Yeah, 80.
So you could contribute $80,000 to a child's or grandchild 529 plan in year one. Now you can't give any more over the next 4 years, but it's a way to front load your 529 plans also. So if you could,
and all that will just grow.
yeah,
tax-free.
yeah, it's a way to get more money in there quicker, so you can take advantage of that timeline.
Mhm. Yeah, it's kind of a nifty little deal for college and things like that. It doesn't even have to be college anymore. It can be for other, I guess, qualified.
It's K through 12 now,
Yeah.
for private school.
Mhm. So a lot of benefits there.
One last thing. If you receive gifts from foreign individuals,
Yes.
if those gifts are more than $100,000, there is a form to fill out. I want to say it's a 3520, but I'm not sure.
That one I'm not going to remember.
But yes, that is the only other exception, that where if you receive a gift, if it's from a foreign individual or a foreign trust, you may have to fill out a form. Still no taxes to pay.
Yeah, that's the key. Is typically you never tax the recipient. It's the one giving the gift, if anybody's going to get taxed. And as we've said, that there's a lot of ways to get around that where you don't even have to be taxed on that. So great question. I think hopefully that will give you some options of what you can do for your son there.
IRS just wants to make sure you're not laundering money for the cartel or something.
Yep, exactly. All right. Let's see here. I'm on Social Security, still an entrepreneur, but currently no significant income over the Social Security. I'm looking to buy a duplex with my business partner's mother, who's also a sole source of income is the Social Security, and where we would each reside in one half of the duplex. I understand that as co-borrowers, we will each be fully responsible for the payment on the property if the other person passes, and the other person is fairly concerned about her liabilities if something were to happen to me. My question is a living trust a possible vehicle to address her concern, either by guaranteeing the payment amount or by paying off and selling some property, some other means such as a life insurance policy tied to the property. Also, in the case of the need for either of us to get or need medical care or facilities that would look at your assets, is there some means by which the living trust or some other financial vehicle may be used to protect the assets for the other party? That's a lot. This is one that definitely Jeff and I kind of looked at beforehand. First of all, we just, we don't like the idea of being co-borrowers in there. You really want to have it separated if at all possible, because that really kind of creates a fly in the ointment on things, because certainly life insurance policies can be set up, to where something's paid off or, that's not unusual. But the living trust, remember, these are different documents for two different people. So they really wouldn't be intertwined too much. And this is really kind of an elderly law specialty type thing. Also, we talked about the 5 years for the irrevocable trusts.
Yeah. Well, let's kind of break us down. Two different unrelated people owning one property. Now, it's not a rental property, it's both their primary residence. First off, I think if you were purchasing, it sounds like it's one property, correct?
Yeah, duplex.
I would probably be more comfortable if you were buying your half and and she was buying her own half. There's still things you can do so that whoever's the survivor can end up with it, the whole thing, whether that's through a will, through living trust. But I think you may have issues with both of you owning half of it and only living in half.
Because we talked about, weren't sure they could even title it out as individuals for each separate half if it's the same loan it's covering the whole
So
unit.
let's look at a couple of different things. Tenants in common, does that work here? I don't know that it does, because if you're tenants in common, you still own a fraction of the whole thing.
That's right. Yeah, I don't think that. I think everything when we're trying to keep it as co-borrowers, co-owners in a sense, but yet call separate parts. Boy, it would just be a lot easier if you could each independently own your own half.
What about joint tenancy
With the right of survivorship.
with the
or
right
something?
of survivorship? Correct.
I mean, that might be a possibility. Basically you just be giving it all over to the other person if one passes. So it might be, but I just don't know that. If you're going to have to make sure everyone's will is saying that, or the living trusts are properly assigning that out for each, and that takes some trust there, because Jeff would never know what I'm writing in my living trust. Nothing to say that would stand as an agreement. So I get back to why we don't want to dodge around this question. If at all possible, we could keep this separate owners. I think that's just going to make your life a lot easier.
So let's talk about a couple things like mortgage interest and taxes. Taxes really isn't a problem, because if you pay taxes, you get to deduct them up to that $10,000 limit.
Correct.
Interest, on the other hand, you have to own the property. So it has to be titled to you, and the property has to secure the loan.
Building.
So I kind of feel like there would be a conflict there.
Yeah.
If unless you're both on title, and then the title gets very confusing for me.
Yeah, and real estate attorneys who deal with this might be able to have some solutions to that. I mean, like some of our staff, our platinum attorneys might be able to look at it a little bit more. From a tax aspect, though, it creates some possible problems we may not want to have to address.
Now let's talk about, she mentioned life insurance. So you and I buy a condo together, or duplex together. I die. We've set it up so you're going to inherit my half. But what about the mortgage? Well, I have life insurance that will pay off that mortgage. So
yeah, that idea I like. Plans can be worked with, like insurance plans, to use those funds. But again, we need to make sure it's earmarked towards that. I never trust the other person if it's, especially, if it's not family or something like that.
So you get my share of the property with a step up in basis, and my death pays off any loan. I want to have my death investigated.
Yeah.
Because you seem to come out really well ahead.
Yeah.
Now, my problem with the insurance in this case is you both mentioned you're on Social Security. So we know you're at least 62. And the problem with life insurance is it gets really expensive as we get older.
That's
even term life.
Great point. Yeah.
So yeah, it's still a good idea, but is it going to be plausible to do that?
That might bring it. Jeff brings up an excellent point. Those rates are much higher as we get older, so that could even put down. Well, I kind of like that idea a little bit, because life insurance plans are used often to pay off debt in a business or something of that nature. There might be a play there, but those rates are probably going to be pretty high.
So one thing you want to do at a minimum is talk to somebody who does estate planning. Pio's group does.
Excellent source.
Yeah, John Anderson, who does estate planning, and talk to them about what you want to accomplish. That you have this, you want to go in together, buy this duplex, have you both own it, but should one of you pass suddenly, you want the other one to get it as mortgage free as possible.
Yep.
So I strongly suggest you talk to somebody right about that, to make sure that you're addressing your concerns, and they can help you out with that.
Absolutely. Great question, though. All right.
I picked it just to.
I have a $14,000 tax liability for 2021. I need to open a SEP or a simple IRA to reduce the 21 tax liability. What else can I do for 2021?
Well, let's talk about the SEP or simple. So you need some kind of retirement account. Traditional IRA and Roth IRA, you have until April 18th to fund that. Now, as far as, excuse me, the simple or the SEP or even a 401k or any kind of qualified retirement plan, it's going to depend on where your income's coming from. If it's coming from an S Corp or C Corp, like you're drawing a salary, you could set up a 401k plan for that. If it's coming from a partnership or from self-employment, you could go the SEP route. It's probably a better way to go. I don't know about the simple IRA.
Simple just has a very low amount that you can contribute to it. The bonus of that, though, is that your SEP is going to be based on up to 25%, depending on if it's an employee, or 20% if you're self-employed, of your overall earned income. So the simple doesn't have that limit. So you know, if you're looking at lower amounts and want to max, maybe the simple, I think it's about 14,000, as I recall, approximately, give or take. Whereas the SEP has that higher limit, almost equivalent to the sole 401k, 58 in 2021 plus 6.5 for the over 50 or 6,500
for the catch up.
Yeah, for the catch up. And so higher amounts you can put into the SEP, but if you don't have a lot of income, because you are hampered by that 20% earned income from your self-employed business, potentially. So that would certainly be one, but you already know that in your question that is something that you're already looking at. So you might want to calculate there, as Toby says, and, you know, calculate, see which one gives you the best of the two that you can put the most into there. So there are other options outside of what you address here. The next one that's popular is an HSA, but you're going to have a high deductible plan, which is approximately $1,400 deductible for a single, $2,800, I think, for married filing joint if in 2021. And you may not want to change your plan that you already have. So that, you know, comes with baggage as well. It's not a perfect idea, but if you could make that work, if it does fit into your scenario, it's a great deduction.
Yeah. Once the year has ended, it makes it really difficult to find deductions.
And I think that's the key point.
We could talk about if you own a real estate, can you do cost segregation? You could do that. But then again, we have to look, are you a real estate professional? Are you going to actually be able to use the deduction?
Right.
So yeah, once the year closes, it gets really hard.
Yeah, the options kind of get limited, but employment plans, as you address here, HSAs, those are things that we are allowed to do after the books have closed for 12/31. But then it becomes,
time is also running out for HSA. That's also April 18th.
Yeah. So we want to get on that if it's at all feasible. My LLC bought a fixer upper in 21 and sent a 1099 to the contractor who did the repairs. My property is now rented. Does my LLC have to include this 1099 for repairs in 2021 taxes, or do we have to wait until the property is sold? Well, a couple of things here. Is a fixer upper, and we're talking about renting. So this really, I think, twists on or turns on what was the original intent when you got the building? What was it you were trying to do? And not that intent can't change over an investment time, but we really need to know that, because you're talking about fixing up and then selling right away, and there was some rental in there. So it doesn't seem like we really know what it was. Was it a flip or was it a long-term investment? And that's going to change our answer a little bit.
Right. So again, it depends.
Yep.
This is a case where you really want to be careful about how you segregate your expenses. If this is a flip, it doesn't matter. Right. It's all going to go into the basis, and then that's going to be a case of where you're going to be included in your cost when you sell the property.
Yeah, not until.
If it's a rental property, I bought a $50,000 property that was really beat up, and I put a lot of work into it to make it livable. A lot of that's probably going to go into the basis of the property also. Because here's what typically happens. I can have two properties that are identical, or should be, One's selling for 100 and one's selling for 50. Why is the one selling for 50? Because it's the $100,000 model that just had the tarnation beat out of it. So I know I'm going to have to put money into it to get it back up to that standard. Well, IRS doesn't want to let you write that off as repairs because they know that you are bringing it back up to standards. And that house probably should be worth the $100,000, so they're identical. So a lot of times we're going to, what's the word that I'm looking, capitalize. Capitalize those costs.
Which means depreciate, typically.
Now, again, we talk about cost segregation. If you're a real estate professional or if your income is not all that high to start with, we'll say below 150, then you might want to do a cost segregation where you can actually pick out what pieces of those repairs and the actual cost of the house that you pay for are not really the building, but are parts of the house, furniture, fixtures, things of that nature.
Exactly right. So yeah, first, again, the key, is it a flip or is it a long-term hold rental? You note going into rental, so I'm going to say that it is, you're going down the path of being a rental. Any repairs up right before it was available for service, available to be rented, will go to basis to be depreciated. Any repairs after that or any work done after that will either be a repair or it will be an improvement, which will be added to basis. Repair deducted immediately in the current year, improvement added to basis. But then, as Jeff points out, you can do things like a cost segregation, perhaps break that depreciation up, speed it up, and then if you hook it with bonus depreciation, you're getting a massive deduction potentially right away the first year. But how's that affect our return? All depends on whether or not it's going to be a passive investment, right, or is it active. And so unfortunately, your question's got a lot of deep crevices to go into, but that's what's kind of neat about it. You know, it shows that there's a lot of flexibility here, but we need to know what is happening on your return. Are you a real estate professional? Is it a short-term rental that you're materially participating in or not? And those type of things. Or are we looking at the true passive activities land? But if you have 100,000 AGI, as Jeff mentioned earlier, you can deduct up to 25,000 of passive losses in real estate. That's unique to real estate, not in the Bitcoin example, as Jeff pointed out. But is that slowly phases out as your AGI gets to 150. So you may lose that too. So if you have a high AGI, 150 plus, you may get stuck in real estate, you may get stuck in passive losses, which isn't the end of the world, and you may have a plan for that, but just be aware of it. I'd hate to see a situation, put this money in there, fix it up, and you aren't able to release that expense to help you out immediately.
One thing I don't like to see on a Schedule E, which was where you report rental property, is this big giant number under repairs.
Right.
It's just because if I'm an IRS agent, I'm going to go look at it and say, I wonder if these really were repairs and if they can prove them.
Yeah.
I don't like giant numbers unless my income is also giant. If I'm bringing in $100,000 of rent a year, I don't mind some of those larger numbers on the expense side.
Kind of has to reflect what else is going on the return, you know, and be in line with what you would expect, what's reasonable.
And you often hear people say red flag, red flag. Well,
that'd be it.
Yeah. There's really no such thing as a red flag. IRS does have its programs that are looking for certain things. And when I worked there, they didn't even tell the people who worked there what those programs were looking for.
I'll let that information out.
However, like the Schedule C, and the Schedule C is even worse of it. If I'm seeing numbers that just don't make sense. I have $8,000 in revenue, but I have $50,000 in travel. Don't give them stuff to question.
Yeah, I mean, that's kind of you're throwing a snowball at them to hit out of the park there. So there's things to get out. But again, back to the 1099 is going to be going with the year that it was put into, associated in 2021. Certainly, it's going to be attached to that. It depends what we're doing with this property. Did we put it in the service or not? Or was it a flip? Like Jeff said earlier, if it was a flip, well, then it'll just go with whatever year you sell it, 2021, 2022, or whatever. The rental, though, we have to look at, was it before placed in service?
And good job on giving them a 1099.
Yes, absolutely. Yeah, make sure you're doing that. I've never, ever worked with a contractor. Don't engage them until they fill out a W-4 first for you.
W-9.
Excuse me. Yes, W-9. Yeah, W-9, so that you know how to tax them. Make them fill that out every year. I have not had a year yet where I don't get asked about that. Well, I didn't do it. And
Yeah, I'll take a step further. You said don't work with them, which I agree with. Don't pay them a dime until you have that W-9 in your hand.
absolutely. Yep. Yep. All right. Great question. Next, if I rent a property, is it better to declare it as personal income, or should I better register it in an LLC or an S Corp? Thanks.
What do you think, Elliot?
Well, certainly I like the idea of using an LLC, not having it in my personal name for asset protection purposes.
Right.
Okay. Because if Jeff has his rental property and he makes that cardinal sin of having Elliot as a tenant, I'll sue him. And if it's in his name, I'll end up taking the whole house from him. So put it in an LLC, absolutely. Now, it doesn't necessarily have to have been bought in the name of the LLC, but you do want to get it transferred in there, signed over. You got our Anderson staff that does that all day long. We put it into these things for asset protection. But what about how that LLC, the one thing we know about LLCs, and a lot of our clients should, that doesn't tell us anything about how it's taxed.
Correct. So you mentioned an S corporation.
Yes.
I don't particularly care for property or assets that can appreciate to be put in an S Corp or C Corp.
Yeah.
The reason is they're difficult to get out without triggering tax. And I'll give you an example of when you might have to pull a piece of property out. I have an S Corp. I want to refinance it. It's in an S Corp tax, or LLC tax as an S Corp. And you hear from the bank, well, we don't like that. We want to refinance in your name, and then you can put it back. Technically, that triggers a taxable gain if the property has appreciated in value. And there are other issues. So if it was a partnership instead of an S Corp, I can put it in, I can take it out, I can put it back in, I can take it out, and all day long. Please don't do that. It makes all my people crazy. But those transactions don't trigger taxes. Corporation is even worse than the S Corp.
Yeah, C Corp.
The C corporation, yes. But yes, definitely the LLC. You can have multiple properties in an LLC. One thing Toby says when they are asked, well, how many properties can I have in the same LLC, is what is your risk
Tolerance.
risk tolerance?
Yeah, yeah.
How much can you afford to lose?
Yeah, it's kind of like how many properties can I put in there? Well, how many, angels on the top of a pin or whatever it is. You can put unlimited amount in there. But again, if you have Elliot in one of those and I sue against the LLC, which owns all the others, you just let the ultimate Trojan horse in there.
Mm-hmm.
And that's just bad asset protection. So get it in there, and not just have it in the LLC, but you want to have it owned by an entity that's going to give you further asset protection. And all of our clients know we love to work with the Wyoming holding because it has that charging order protection. So that's, we certainly want to get into that kind of setup at the very least. How is that LLC taxed? Not as a corporation, not as an S or a C. Keep it disregarded up to that Wyoming holding, and either have that Wyoming holding disregarded to you or in a partnership, one of those.
A little bit about asset protection. Excuse me. I know we like to trust people.
I don't, but
you can't. When it comes to your finances, you can't. I've known of people who have been injured, possibly not even on the property, but have done stuff like pulled up carpet and things of that nature so they can sue their landlord. So make sure you're adequately insured, make sure your liability protected through an LLC or something. Bad things can happen. What you want to do is mitigate the possible negative results.
Yeah, I think Clint has some of the best stories about that. With some of his family renting out some buildings where they had just bad tenants doing bad things, drugs and whatnot. If you ever see him in the asset protection, tax and asset AP class, he goes into that quite a bit, talking about that. And it's just something that you can be responsible if someone just turns off your smoke detector, you know, that and it's your tenant. You didn't have anything to do with it.
Right.
Lots of little things like that. I remember back in the days, if we go back, you know, as people talk about a possible bubble and all that. Well, I don't know if that's happening or not, but I remember back in the old one, I'd hear constantly from clients and people like that. People would throw down cement down into the pipes, and you're just purposely wreck the house, you know. And so you want to have LLCs and of course insurance as well. But you just never know what kind of damage is going to come and what kind of lawsuit.
Yeah.
So protect yourselves. Great questions. Next one, can you explain what cost segregation is and how you apply it when you buy a rental property? What can be best used in cost segregation? Also, if you depreciate a rental property for 5 out of the 27.5 years and then sell it, how does the depreciation recapture work? How would you calculate it? Fantastic question. It gets back to a core of a lot of questions we had today. Any thoughts on that? You want me to go?
Go.
All right. The example I give to everybody, and those who've heard talk to me or whatever before, it's the same one. You know, normally we straight line depreciate a single family residence over 27.5 years. That's where our clients getting that number, 27.5. So you take the cost of the house plus any improvements, less any depreciation. That's your adjusted, well, before we begin that, cost of the house plus improvements, divide by 27.5 years. That's your same depreciation each year, straight line depreciation. Now, cost segregation steps in, it's a different form of depreciation. It says, well, now hold on, Elliot, that house has all these different parts, carpet, lights, doors, foundation, and all those independently have their own tax life, 5-year, 10, 15, 20, and some are 27.5. Cost seg breaks those pieces apart. And when you've done that, now your carpet tax at 5 years, instead of depreciating over 27.5 years, you've sped it up to 5 years. You're going to get a bigger loss, a bigger deduction, which can be good done right on your tax return. So you got all these properties, or all these 5-year categories and 10 and such, you know, that are speeding up that depreciation. Now, right now, this year, 2022, you can couple onto that bonus depreciation, which says any 5, 10, 15, anything under 20 years can be deducted immediately 100%. So you get this massive depreciation. That's the key to it. That's what you always hear us talking about it over and over and over. Next year, it's still really a great deal. It goes down to 80% bonus depreciation, not 100% anymore, but still a really great deal. I personally think that's one of the reasons no one ever talks about why people keep investing in houses right now, even though prices are going up. They're usually investors. That's just it, because they know about the appreciation.
Yeah. So let's say I have a $250,000 property. 50,000 of it's allocated to land. The rest is the building. I go and do the cost segregation. They say, oh, these cabinets are 7-year property. Your appliances are 5-year property. Oh, you have a swimming pool. That's $50,000, 15-year property. So by the time they get finished pulling this out, I have a house that's now has a basis of 100,000 because I pulled another $100,000 out and all these other assets, this cost segregation.
Huge deduction.
So I'm a real estate professional. I've taken that depreciation in the year that we did the cost segregation. But a couple of years down the road, I sell the property. So I only have a basis left of $100,000, and well, I'm not going to worry about the depreciation on that. Plus $50,000 of land. So my cost in that sale is going to be much lower than it was originally, because I've already taken that deduction for the shorter life assets.
So we're looking at more capital gain potentially, because you have that lower adjusted basis. And then our client here on this question very astutely asked, well, what about, you know, the depreciation recapture if you said you had it, let's say 5 years? Now, if you've made it up to the 5-year point, then all that 5-year property you can basically write off. Yes.
Yeah, the bonus depreciation for some reason is not subject to recapture.
There you go.
I don't get it. So yeah, it's a way to, you're not recapturing all this depreciation there. Instead, you're paying capital gains on the house itself, which you really want to do, because you don't want to pay what's called Section 1245 recapture at your ordinary rates. You want to pay long-term capital gains at those lower rates.
Yeah, that's a big point there, is that this property is no longer what we call real property. All those 5, 10, 15, we turned it into what's called 1245, or basically tangible property. Different depreciation rules there. So you might have some, you're going to get taxed at ordinary rates, but if it's on 5 years and 5-year property, you can go ahead and just write that off. Typically, you don't have to worry about that. Now, 10-year property, you're going to have some capital gains that you got to pay tax on, but not the 5-year in this case.
So let's go back for a second, back to the 1245 property.
Yes.
Anything under 20-year lives. Here's why the depreciation recapture doesn't happen on that. When I go to sell my property, I am allocating all the sales price to the land and the building. I am not allocating any money to my carpet or my garage door or this or that, because I'm figuring those are probably pretty much worthless. They've already been fully depreciated and so forth. So the thing with depreciation recapture is limited to the gain on sale. If I'm not selling those assets if I'm not getting any gain on those assets, the short life assets, then I don't have any recapture on those assets.
Exactly. So that works out really well at that point, but you're still going to get, because as Jeff points out, you did lower your adjusted basis. So you're going to have more capital gains. But also I'd say, let's not be afraid of capital gains. That's a far better deal than, 37% if you're in a high tax bracket. So it's always going to be lower. I can't think of an instance where capital gains would be at the same level as your ordinary capital tax bracket. So it works out really well that way.
So let's talk about, I'm not a real estate professional. Cost segregation always works if you're a real estate professional. Or what's the other one?
Internally participating short-term?
Short-term rentals.
Yep.
Which aren't really rentals, but we're not going there today.
Yeah.
But let's say I'm not a real estate professional and I'm holding these long-term properties. Why would I do a cost segregation? Well, I'm not going to be able to take the loss, but that loss doesn't go away. It sits there until you get rid of the property or you have other passive or income. So I hold it for 5 years. I got this $100,000 of depreciation expense that I've never been able to take the loss. When I go to sell the property, it releases all of that loss.
Lets the pals out.
Lets the pals out. Who's your pal? So yeah, it's a good opportunity to take it at that point. And we do have a few clients that have a lot of losses from cost segregation just sitting there. With a full realization, they weren't going to be able to recognize them at that time.
But man, when they sell it, those things just come out. And if they have multiple properties, you sell one property. This is, again, you're not real estate professional, so you didn't aggregate or anything like that. You sell one property, all your pals get released to help defeat the capital gains on that property. So not just the capital gains are associated with that property, but all of your pals get released for that to wipe it out. Can't be used to go higher on other things on your income. But if that one property had more pals than what, let's say, the gain was on it, then those extra pals have been released, and that will go against other income on your return for that one property. So some neat things can happen with it, even if, doing the cost seg, there's just a lot of benefits to it. A lot of people, we have the specialist that we work with, Cost Seg Authority, Eric Oliver, speaks with Toby a lot. I think he was on one of the recent events. I can't remember which one it was, but fantastic guy, fantastic team. And they'll tell you about, just the benefits of selling, even the year of when you think about selling out, maybe it's a good play, and they'll explain why, all the different rules and scenarios around it.
Here's another strategy you can use that kind of goes along with what you were just saying. I have a rental property. I actually have 2 rental properties. The one that has $100,000 cost segregation, but I'm planning on selling property 1, and I know I'm going to have a $200,000 gain on it. When I sell that rental property that has not had the cost segregation on it, that capital gain is passive. So what does that mean? I got a $200,000 passive capital gain, and I got a $100,000 passive loss over here. I can offset those two.
Exactly.
So anytime you're looking to buy or sell, I think that's a really good time to just explore it. You mentioned Eric Oliver. I know he does some quick analysis just to give you an idea of how it would work out for you.
Free of charge.
Free of charge.
Yeah, they'll take your data, give you a rough idea what a cost seg would be. Of course, they'll tell you a rough estimate of what their fees would be to conduct it.
Yeah.
But a great group, the whole team there is great. We always talk about Eric here because we're familiar with him, but just a great group all around there. You will not be disappointed. All right. I'm not sure, but that might be it. Yeah, that is it. All right.
Questions? Hey, before we go on, see if we got anything up there.
Yep. Let's see here.
In the chat side.
I like what you're speaking, Elliot. Let's see here. I don't see. Looking for some questions here. It looks like is the cost of a cost segregation deductible as well? If so, is it taken in the year it was paid?
Yes. So here's how this is going to kind of work out. You can just still get cost segregation for 2021 up until the due date of your return, with extensions if you have an extension. So the cost segregation itself, that extra depreciation, would be 2021. The expense of the cost segregation would go in 2022.
Cash basis.
Cash basis.
There we go. How do we oh, looks like Patty's got that taken care of. Let's see if we have any questions. Make sure register. Yes, it was a tax-wise event that Eric Oliver was at most recent. Great information. Thank you. Thanks for joining. Thanks to all you guys for joining. Can you touch at all on nonprofits? Taxes for nonprofits. I mean, we can say basically, as long as it's doing its mission, if you will, it's typically, if it's earning income related, that's not taxable. It is possible, though, that would mean, that's a great question. I'm sorry, I didn't catch the name. Is it Lentina? You could have a nonprofit get into some business that isn't really on its path of societal benefit that could cause it to pay taxes. We call that UBIT, unrelated business income tax, and it's taxed really high. So we want to really avoid that like the plague if we can.
I'll say this about nonprofits. I'm all for people starting a nonprofit. You have to decide what your mission is before you start, before you create that entity. It's typically going to be a corporation, a true corporation. You'll set up, you create it, you'll donate to it. You could donate cash, you could donate appreciated property is always a good one. We've had people donate appreciated cryptocurrency. If you donate appreciated property, you typically have to get that appraised, even for cryptocurrency. The one thing that is not the mission of your nonprofit is to benefit you. There may be some benefits to you. You get to deduct, you get to write off that contribution, especially that appreciated property contribution.
Yes.
And so forth. But what we really want people to keep in mind is this is you doing something for the community because you've done well in life and you want to pay back. We talk about affordable housing, shared housing, various other things. We have people
I loved it.
Animal benefit.
Oh yeah. I love the one of our clients set up a whole thing for autistic adult children, houses especially designed for them to live in and things. Just neat ideas out there. And I'm sorry, Lanisha, that was butchering your name there, but it's a great question. But back to it, you're specifically asking about taxes and nonprofits. Usually not an issue as long as you're doing your mission. But to Jeff's point, you want to have that mission kind of clear when you start. You want to have something that you're passionate about and you love. Don't just do it for a tax deduction, because that ultimately is just, I don't think you're going to be happy with it. So have something you care about and make sure you're doing it for the nonprofit purpose. And then usually that will help avoid any UBIT or something like that. As long as we have all the staff here, we have an incredible staff that Kareem has set up. He's the head of our nonprofit department, used to work for the IRS as well, probably in the same building as this guy, who knows. but that team will be able to walk you through anything you need to know about the nonprofit. Highly recommend going to their classes.
So talking about what you can invest in your nonprofit, securities, properties, you can't do flipping.
No.
You can't do anything that would be considered a trade or business. And my usual example is St. Elizabeth Hospital is a nonprofit. They don't pay tax.
But they're doing that bingo.
They have a gift shop in the lobby, so you can buy stuff for your loved ones that are in the hospital. That gift shop is owned by the hospital, but that is what? It's UBIT.
Yep.
Because it is unrelated to their business purpose. It's a side business in IRS.
Very good example. Yeah. So it's something you want to watch out for. That UBIT is nasty. Why? Because it has the same tax brackets, but they rise really quickly. So it takes very little income to be at the top bracket, paying 37% or more. Yeah, so you just want to watch out for that. Let's see if we got any others here. Lanisha, again, I have a nonprofit that will provide a home to the aging, foster youth, and I'm looking to get properties to rehab to allow them to help rehab and live in for 12, 24 months at no cost to the fosters. That might be an issue because you're doing that rehab thing. If you're thinking, excuse me, rehab's fine, fixing it up perhaps, but not selling, not flipping. We want to watch out for that. Again, though, Kareem and staff, we have that nonprofit event. I don't know what the next date is, but we have that on our website under events, and Kareem is just excellent.
Yeah, I'm kind of on the fence about that one in particular, about if you're buying properties at low discount that are cheap, fixing them up and then selling them. You really need to have somebody look at that model. That may actually be okay, but
want to be very careful with that one, though.
Yeah,
that can get you into trouble. And what can happen with the UBIT is, Kareem has told me, is that they could, in egregious situations, take away your nonprofit status. And so, yeah, we want to watch out for that.
The other term you want to be aware of is private inurement.
Yeah.
Means you can't profit from your nonprofit.
Yeah.
You can certainly take a reasonable salary for what you're doing, reimburse expenses to you for things that you provide for the nonprofit. But over and over again, you're going to hear the term reasonable.
Yeah. And, so the idea there is you donate 100,000, don't give yourself a $50,000 paycheck. That's just not reasonable. So, no business would be able to run on that. No, why should a nonprofit be able to?
We love the nonprofits and we love the people with good motivation for doing it.
Yeah. Yeah. And that is the real, I talk to a lot of clients who do this and they do that thing that they're passionate about. And they tell me, years down the road, they always say the same thing. The deductions are nice, but really it truly is. It's that they feel like they've done so much more in life than any deduction. It's just doing that whatever that societal benefit is that means something to them. And that's incredible. And we got clients doing all kinds of things. I know one client who helps out with acting for minorities, I believe it is. You got, of course, all the housing. There's just everything. Dogs for the veterans. That was the most astonishing thing. One of our clients does these dogs for post-traumatic.
Yep.
Yeah.
I got the t-shirt.
And something like 100%, just incredible success rates with those little dogs. They're not little like German Shepherds, but just amazing things our clients are doing with those. And so a lot of great stories, very inspiring.
Yeah, these nonprofits work best where it's your passion. Questions, you can email us at taxtuesdays@andersonadvisors.com, and please visit us at andersonadvisors.com. We got a lot of good material out there. Look for the video page, look for it on YouTube, and I think it's the next slide.
We're always adding more.
Oh,
there it ended.
Go back to that other slide. We appreciate you stopping by and listening to me and Elliot chat.
Yep.
Try to answer your questions. Toby, hopefully, will be back in 2 weeks.
I'll be in the back answering questions.
We'll chain Elliot back up to his desk.
There we go.
No, I appreciate you filling in for him today.
Happy to do so.
And everybody have a good week, and we will see you next time.
Good night.